If you took just $10,000 and invested it in a 60/40 portfolio 10 years ago, today it'd be worth $26,000. But with Bitcoin, you'd be sitting on 4.8 million. And most people today are struggling financially because they're using outdated frameworks that were built for a different era. And I realized this a few years ago, flipped the way that I approached my own money, and it changed my life forever. So in today's video, I'm going to walk you through my background, how I found Bitcoin, and all of the traditional financial principles that I was forced to unlearn along the way. So let me start at the beginning. Like most millennials, I grew up during the 2008 financial crisis, and I watched my parents, family, and friends' parents all get hit really hard financially. But as a kid, I didn't fully understand what was happening, but the hardship our family went through left a mark on how I viewed the financial system that would later force me to face the reality that something bigger was broken. And as a result, money was something that I took an interest in from an early age because the fear of not having it was something that I didn't want to experience again. And then it led me to studying financial planning in college, where I learned everything from retirement strategies to estate planning and investment management. After graduating, I started my career at Vanguard, one of the largest investment managers in the world. I got my Series 7 license and spent most of my time talking to thousands of clients about investments, taxes, and placing trades as a stockbroker. Working here gave me a really unique insight into where most people are at when it comes to managing money. They start too late and just have a basic understanding of how investments work and don't have the time to manage money like a full-time job. Eventually, I'd moved to a smaller financial planning firm where I worked with higher net worth clients. Their situations were more complex, but the principles were exactly the same as what I'd been taught in school and at Vanguard. Diversify, max your retirement accounts, follow the withdrawal rules, and pay down debt. And for decades, these rules have worked well enough, but for me, working inside the system and going to school for financial planning, it wasn't until the world shut down that I really started to ask deeper questions. When COVID hit, the world shut down, businesses closed, and millions of people lost their jobs almost overnight. Financial markets crashed, but almost immediately, cruise ship and casino stocks were ripping higher while millions were out of work and the market was completely disconnected from reality. And for the first time, I realized that something was wrong. It didn't seem right to me that the stock market was going up while most of the country was suffering. It's around the same time I'd remembered Bitcoin. A friend at Vanguard had told me about it. I bought a little bit and then quickly sold it and moved on. But this time I decided to come back, dig in, and really learn about what it was. The same year, what college and the financial advising industry failed to teach me, I absorbed in books. I learned things about monetary history, debt, the Federal Reserve, the banking system, and economics that they don't teach in school. And what I came to understand was that beneath retirement accounts, investments, tax, and estate planning was a financial system that was fundamentally broken. The truth is that dollars we're using to measure returns are built on sand. The banking system only papered over the financial crisis, and the problem was still very much alive and well. I found that Bitcoin wasn't just a speculative gamble, but a solution to the underlying problem that was hiding beneath the surface: unlimited money printing and inescapable debt. And if this was true, all the financial principles that I had been taught previously needed to be reevaluated. Everything I learned was built for a world that didn't exist anymore. We have a new financial solution for the 21st century that completely rewrites what worked in the past. But to understand how, you need to understand these traditional financial principles first, and then I'll go into how Bitcoin obsoletes them. The first principle is one that you've probably heard of before, called the 60/40 portfolio. For decades, 60% stocks and 40% bonds was the gold standard for a well-balanced investment portfolio. This principle was introduced in the 1950s by Harry Markowitz as a framework for maximizing reward while minimizing risk. It gained popularity in the 1980s during a period of higher interest rates, slower demand, and elevated inflation. And this strategy worked for two main reasons. First, investors benefited from the majority of their portfolio being in stocks because it grew faster than inflation alongside the US economy. And then second, the 40% that was in bonds protected the downside during a market crash and provided low-risk, guaranteed income. The difference now is that interest rates are a lot lower than they were in the 1980s, which means lower income for investors. And then at the same time, debt loads across governments, corporations, and municipalities are a lot higher, increasing their default risk. Government bonds carry a hidden risk, meaning that they'll pay you back, but they'll do it with printed money, which gives you negative real returns. So your investment's not going to zero, but you're agreeing to lose purchasing power. And since no one wants to sign up to lose money, bonds have suffered their worst performance in decades over the past few years. The macro environment has fundamentally changed. We have lower interest rates, higher debt, and persistent inflation. This shift exposes just how fragile the 60/40 portfolio has become. and why Bitcoin's emergence as a superior store of value is so disruptive. Bitcoin is more scarce than stocks, and this scarcity allows it to benefit even more from money printing. And it doesn't carry some of the same risks that stocks do in CEOs, management, employees, or competition. Some parts of the investment world started waking up to this reality in 2022, one of the worst years in history for the classic 60-40 portfolio. Historically, bonds acted as protection. Stocks down, bonds stable. But as inflation picked up and rates rose, both assets fell together. Bitcoin may be misunderstood, but it's a robust, highly secure technology that's just a better way to store value and protect your money. Traditional finance is asleep at the wheel, stuck treating volatility and risk as interchangeable. That may be true for a small cap stock, but not for Bitcoin. Bitcoin is software that's proven itself against thousands of competitors. And volatility can be managed through position sizing, so if you need to sleep at night, you can hold a larger cash position. Whether you choose 100% Bitcoin or a 60-40 split or some variation of this is completely up to you, and it's a personal decision. Your personal situation determines how much volatility you can handle and what Bitcoin position size and allocation is right for you. But investing with a 5-year time horizon or longer makes it significantly easier to ride through some of the swings that are still common as Bitcoin gets adopted. While the 60-40 portfolio was the most optimized risk-reward strategy of the 20th century, Bitcoin is now the highest risk-reward portfolio in the world and should make up a much larger share of your portfolio than traditional finance recommends. And over the last decade, Bitcoin averaged 82% returns per year. And the 60-40 is just at 10%. And that gap in returns changes a lot of assumptions in personal finance, and it's what led me to start questioning how I approach retirement too. 401ks became popular in the 1980s after the IRS allowed employees to contribute to retirement accounts in a tax-advantaged way through payroll deductions. It was a simple, automated way to save for retirement and let investments grow tax-deferred for your entire career. And by the late 1980s, almost every company offered some form of match. Traditional advice will tell you at the very least to contribute up to the employer match and ideally max out your 401k every year. If we compare the 10% annualized returns of the 60-40 portfolio to Bitcoin's 82% annualized returns that we talked about in the last section, there's two major things that you really have to consider when deciding how to allocate your retirement funds. The first is that most 401ks only offer traditional stock or bond index funds. So the benefits of the employer match and the tax deferral don't come close to what you give up by missing Bitcoin's performance. That return gap, compounded over decades, can mean millions of dollars lost to weaker returns. Second is the issue of position size and accessibility, because most people spend their entire lives contributing to their 401ks and IRAs, and it becomes most of their investable assets. Which is great in the traditional world. This would give you around 3 to 4 million by retirement. But retirement accounts come with restrictions that just aren't talked about enough, because what took you 30 years in the old world can now be done in 10 with diligent Bitcoin saving. The problem is that you can't access 401k funds until around age 60. So if you withdraw early, you'll face a 10% penalty plus taxes at your ordinary income rate. And I'm not saying to ignore retirement accounts completely, definitely take advantage of the tax benefits, but neglecting non-retirement Bitcoin can leave you with fewer options down the road. I can't say when this point is for you, but I think it's crucial to really think carefully about how you're splitting contributions between your retirement accounts and Bitcoin, so that you have money available to you throughout your whole life. Because not only is it important to think through how you're saving for retirement, but Bitcoin also challenges traditional assumptions about when you can retire. So when can you retire? This is a question that you've probably asked yourself, and it's one of the most common in finance. And in 1994, William Bengen found the answer to this question by looking at historical market returns to see how much retirees could live off of and not run out of money. He called this the 4% rule, and it simplified the fear most have of how much you need for retirement into a simple formula. With the 50-50 stock bond portfolio, you can safely withdraw 4% every year and not run out of money. So for example, if you had $1 million, you could take out $40,000 a year to live off of without depleting the $1 million nest egg. And this made retirement savings goals a lot easier for people. And it was widely adopted by finance professionals everywhere as a proven formula for retirement. But as we covered in the last section, the stock bond portfolio is being replaced by a lower risk, higher performance alternative. So what does this mean for the 4% rule? What it means is that we need to reevaluate this number higher to account for the increased performance. William Bengen had decades of historical performance to test his model against, but with Bitcoin, we only have 16 years. So what I've decided to do is use conservative numbers for what I believe Bitcoin's growth could look like in the decades ahead, because as an asset grows, something called the law of diminishing returns takes effect. This just means that as an asset grows larger, it takes more money to move the price higher, and returns will slowly come down as adoption increases over time. If we think about Amazon, it's easy to double in the early days, but much harder once it hit the $1 trillion mark. And if we use Michael Saylor's model, Bitcoin's long-term average return is projected at roughly 24% annually over the next 30 years. But today we're still in the 40 to 50% per year phase, and early contributions compound the fastest. So being extremely conservative, we can double the rule to 8% with Bitcoin as the core of the portfolio and 1 to 3 years in a cash buffer. And I like to be conservative because, like Amazon in its early days, Bitcoin is still misunderstood and volatility remains high. Holding a cash buffer helps you ride out temporary drawdowns without being forced to sell. So what does this mean for you? This means that you need half as much money to retire, or you can spend twice as much with the same portfolio size. For example, with the traditional 4% rule, you'd need a $2 million portfolio to safely withdraw $80,000 per year. With Bitcoin and an 8% rule, that number drops to $1 million. And at 10%, it's just $800,000. This strategy relies on holding a majority Bitcoin position with a small cash buffer, and it flies in the face of everything that traditional finance is going to tell you to do. Which brings me to the next principle that I had to rethink, called diversification. This principle is taught and practiced by financial professionals everywhere, and it's the idea that an investment portfolio should spread out risk across several assets that are unrelated to each other. Benjamin Graham, the father of value investing and author of the famous book The Intelligent Investor in 1949, advocated for diversification as a safety net, that holding 10 to 30 stocks would protect you from one going to zero. Then the rise and invention of low-cost index funds in 1976 by Jack Bogle transformed the investment world, giving millions an easy way to track the largest 500 companies in the market. Since then, diversification has been the mantra of modern finance. Index investing has proven to outperform most hedge funds and active investors. And anything other than this strategy is seen as reckless and irresponsible. And finding Bitcoin forced me to rethink this entirely, because it's not a company or government debt, it's a protocol like the internet. What I learned is that Bitcoin's value and adoption comes from its use. Its use is as a store of value that outcompetes all other financial assets. And that Bitcoin is one. It's outcompeted all other cryptocurrencies as the best store of value, so there's no reason to diversify into inferior versions. We live in a new paradigm now. Higher inflation and debt means higher asset prices. And in this environment, you want to be in the asset that goes up the most with the least amount of risk. And that asset is Bitcoin. Being all in on Bitcoin is seen as radical, but from my perspective, it's rational, practical, and risk averse. Diversification means selling your winners to buy the losers, but with Bitcoin, I don't think it's necessary to diversify like we had to with stocks as our primary investment option. Everyone has different goals and risk tolerance, so this isn't meant to be a one-size-fits-all, but just to challenge your beliefs like mine were 5 years ago. Since then, I've made some pretty drastic changes to my investment philosophy and personal finances, so let me show you exactly what I did. After a few months of learning and studying, I came to the conclusion that Bitcoin wasn't just a risky, speculative technology to put a side bet on. It had drastic implications for the world and changed everything about what we were taught about investing and personal finance. Bitcoin needed to go from a small part of my portfolio to the core of all of my financial planning and investment decisions. Extreme investment returns with lower risk changes everything about what we're taught in financial planning textbooks today. So retirement accounts, debt, budgeting, and investment management all came into question. I started by selling the index funds of my IRA and converting them into a Bitcoin IRA. I then sold the ETFs and S&P 500 funds in my brokerage account and converted those to Bitcoin and cold storage. Once I had enough in retirement accounts, I started allocating to Bitcoin and cold storage instead to make sure that I had money available penalty-free throughout my life. I dropped my 401k contributions at my employer to zero and started buying Bitcoin instead. And then I've used debt as a tool rather than something to be scared of. And lastly, I bought Bitcoin instead of a 20% down payment on a house or extra mortgage payments. So now it's been 5 years since Bitcoin's become the core of my investment planning, and what has this gotten me? Most traditional finance told me I would lose all of my money, that it's irresponsible and risky, that I shouldn't have more than a 5% allocation. But while CNBC talking heads rejoice over 12% returns in a well-diversified portfolio, I've gotten 50% returns per year just by updating traditional financial frameworks for one with Bitcoin at the center. Bitcoin forced me to question everything that I thought I knew about financial planning and investing, and it's changed my finances forever. Now, you don't have to copy what I've done, but I want to challenge you to question what you've been told about money, because Bitcoin is a new paradigm and it could change everything for you. If you like this video and you want practical Bitcoin personal finance and planning tips sent straight to your inbox, check out the link in the description below. My name is Austin. Thank you so much for watching, and I'll see you in the next video.